the other class. So I'm encouraged by that. We'll talk about that, and don't forget in the online discussion, you've been doing some good online discussion this week. This week we're doing one post on screen 1. That's where you either did research or find a qualified intermediary who would facilitate a Section 1031 exchange. We'll be talking about the numerics today with some handouts that I prepared. Then that will be a heavy area on the exam as well, so we'll want to pay a lot of attention to that. And then on the second computer screen with the depreciation and the basis rules, we're doing the usual 3. Next week in the online discussion, we'll do 3 posts on screen 1. That'll be capital gains and losses. I'm going to put the wash sales rules in. I'm going to want some historical analysis of how capital gains and losses rules have changed throughout the years. And the holding period has been from as little as 6 months to as much as 18 months to determine short versus long term. So we'll look at some of those areas as well. The second computer screen deals with corporate reorganizations. That will do 1 post. So this week it's 1 and 3. Next week it'll be 3 and 1. And I think the following week is 3 and 1. But make sure how many days are involved? 3. Okay. I don't have to lecture this class. You guys have been doing great. Also, due in week 7, because next week we got an exam. We're going to have the research you decide. So we're not doing that assignment that's in the shell this week. The only things we have left are the exam in class next week. Then we have a you decide that's down for week 6. We're doing a different one, and it won't be due till week 7. It'll be due in class in week 7. You can just bring in a hard copy. Next week, I want to pass this out now, but next week after the exam, I want to give some hints. This is a hard assignment. It used to be in the shell. They put something in now that I don't think is adequate. And this will cover areas like net operating loss carryovers, the S corporation election, reorganizations, primarily just A through D, not the EFG. So please bring this with you next week. You can read over it before class, certainly. It's confusing and it's heavy, and the way, I'll tell you how I grade it, because I'm not looking for an exact correct response. Usually what I'll do is I'll take all the papers, and that'll be from both classes. I'll combine them because they have the same assignment. And I'll read them over one day. I'll put on a sheet of paper, I'll take a tentative score.
Thank you.
And I'll write a few notes for myself. Then I'll hide that sheet of paper. Then in another day, the next day probably, I'll look at the papers again, read them a little bit more closely, and I'll put scores down on a separate sheet of paper. Then the third day is my final run through. Now it's interesting to note that 90% of the time, the score I had each one of the 3 days that I put down independently agree with each other. In the other 10%, about 2/3 of the ones I think I was too harsh, and I raised the score. The other third, I think I was too liberal, and I reduced it. So you're just in competition with the other people in the class. There's not necessarily right or wrong answers. I'm going to want you to get to do some tax research. When I taught at North Central, we actually had a class where we just did tax research. And that was back in the 90s, before we had as many of the tools available for researching as we do now. So we'll talk about this. This is a wealthy guy buying a company, and he wants to know, basically, does he want to have a corporate reorganization to combine it with another C Corp? Does he want to elect the S corporation election? This company has net operating losses, so he wants to be able to utilize those. And the reason I like this one better than the one that's in the shell is that we're required to cover the S Corp chapter and like the corporate reorganization chapter. But those do not appear on their final exam. Those they never test. So this will just give us a little bit of an opportunity to become familiar with some of those concepts in our research. And being that you've been finding good research articles here, I imagine you should have no problem here. But I want to give some hints, I want to give some ideas, and I'll do that next week when you're recovering from exam 2. So we'll start with that. Now the game plan is we're going to discuss the remaining material for exam 2. So we'll have a break in there so we can go to the baked potato bar. And then we'll go over exam 2, go through all the subject matter so you can be prepared. Then we'll pass out exam 1 and we'll go over the answers, although I will collect it up afterwards. Then we'll start final exam material. We need to spread depreciation over several weeks. We're just going to introduce it today. By the time we get to that level, your head will be spinning. Write stuff down, take pictures, look it over then again when you have a chance. Then next week we'll do some similar examples but different numbers. And next week we'll also talk about the case study, and we'll do the some areas of capital gains and losses. Remember that you decide that word that I just distributed is not due in week 6. It'll be due in week 7, and it'll be due in week 7 on our Thursday night class, so that'll give you enough time. Next week you're preparing for an exam, so I don't want you having to do research too, just do honors. So, yes?
So next week's exam, is it cumulative, or is it just?
It's kind of cumulative. I know in the syllabus it says just those later chapters, but it does have some of it doesn't have personal dependent, none of that stuff from that chapter 3. But it does have some gross income items and some other, business deductions might be on there.
So the lecture from last class, and then today, and then maybe some of the...
Yes.
Okay.
But not as much from the other stuff, and nothing from the first week.
Got it.
Yeah, there's none of that. They may have something on the final out of the individual taxation chapter, but we'll talk about that when we have our week 8 review. Lena may not be able to come in week 8. She has helped everyone by putting on YouTube or something, some pronouncements. If someone could assist her in case she cannot come, let's say maybe on Tuesday to the Loop, please, I think we owe her something, so please be nice. Okay. Before I forget, I want to get rid of this heavy load. Here's some problem solutions for next week's chapters, but I doubt if you'll really be looking at these too much until you prepared adequately for exam 2. Press those down. Those are all hers. Those are all yours.
Here you go.
Good. Well, this lightens my load a little bit. There we go. Oh, did I give you extras?
Does anyone else give an extra 7?
I have an extra 12.
Oh, okay. If you have extras, bring them over here to Bill. Appreciate it. You have a 12?
How many extra, what are the numbers that we're supposed to have?
12,
14 and 17?
14 and 17. Someone might have an extra 14 because I should have.
Yeah, I do.
All right, Donna, can you get that for me?
Oh, thank you.
Thank you very much. Good. Okay, appreciate that. Now let's start. Let me get some handouts ready here. I should have put these down here in a different order. Let's start with this first type handout. When you sell property, you might receive more than just cash. So let's look at the concept of amount realized at the top of this handout. We'll relate this to an exam question next week. Amount realized. If the buyer pays me cash, if he gives me property that I pick up at fair market value. In the exam, it's going to be a building that I'm going to sell. Buyer will give me cash, buyer will give me property, I pick up at fair market value. Tell me what this would be. Liabilities to which the property is subject assumed by the buyer. What might that represent on a building?
Mortgage.
Mortgage, perfect, Tracy's right. There'll be a mortgage on the building that will be assumed by the buyer. That constitutes amount realized. Oh, come up here, I have gifts for you. These are just handouts for next week, but this one we're just starting. Oh, wait, I gotta give you, hold it, I have another one. What do I do with the thing? I have another gift for you. Oh, I can't find it now. Oh, there it is, it's on my chair here, I'm just around it here. Due in week 7. It's the you decide, not the one in the course shelf. Oh, this one. A mortgage will be assumed by the buyer, so that's part of the amount realized. Who has an idea of this last one? Other liabilities of the seller assumed by the buyer. What might that consist of? Taxes, yes. Amy's got, you guys are hot, yes. There'll be some delinquent real estate taxes that the buyer is going to pay on behalf of the seller. So on this problem on the exam, notice there will be 4 items in the amount realized. The cash the buyer pays, the fair market value of the property that the buyer distributes, the mortgage that the buyer is going to assume on behalf of the seller, and the delinquent real estate taxes that the buyer is going to pay off on behalf of the seller. So remember on that exam question, it's a multiple choice computational one, those will be the amount realized. Now one thing I don't show on here, unfortunately, on this handout, so maybe right at the top, amount realized minus selling expenses, amount realized minus selling expenses equals adjusted sales price. On the question, if I recall on the exam, the selling expenses were $104,000, something like that, so they're not chicken feed by any means. So the amount realized will consist of these 4 items. You'll then subtract out the selling expenses. That will give you the adjusted sales price. From the adjusted sales price, subtract out adjusted bases. Now notice how you get adjusted bases. You take the cost of the property you're selling plus the cost of any improvements that you put on the property. In our problem on the exam, I don't know, I'll just make up some numbers. Let's say you paid $1 million for the building originally, and you put an addition on the building that cost $250,000. So your cost would be $1 million plus the $250,000 improvements. This is business or income producing property. So you'll subtract out the depreciation. Now on this particular handout I have depreciation allowable. That will not be an issue on our exam, but I want to talk about it briefly. On the exam I'll give you the amount of depreciation that was taken. This is not for the exam, but I just want to give a warning. Let's say you opened up a new business and you bought a building and put it in service, but you did not bother for the first 2 years to depreciate it for tax purposes because you had a net operating loss. Year 3 through 10, you start depreciating it. After year 10, you sell the building. You've used it for 10 years, you depreciated it for 8. The tax laws say that you are deemed to have depreciated it for the entire period of time in which it was eligible. So you'd have to reduce your depreciable bases by not the 8 years of depreciation that you did take, but by the 10 years of depreciation you could have taken. Now, that would be foolish not to have depreciated those first 2 years. Can you go back and amend your tax return? No, because the statute of limitations has run. And had you depreciated those first 2 years, it would have increased your net operating loss. And remember, net operating losses can be carried back 2 years, but carried forward 20 years. So you probably could use it in that 20-year carryover. So I used to give an exam question where that was an issue. That's not going to be an issue here, but just remember that. So you'll take your adjusted sales price, which was amount realized, minus your selling expense, minus your adjusted basis. Adjusted basis is the cost of the property plus the cost of improvements, minus your tax depreciation, and that will be your gain or loss on the sale. Gain or loss recognized would be your tax gain or loss.
Wait, that's the recognized gain loss?
Recognized, right. When we talk about 1031 later, we talked about the difference between gain realized and gain recognized. Recognized is always what appears on the tax return. This would be a gain recognized here. Now, basis rules. Some of them we don't have to go over. The basis of property received by purchase. We know this from our accounting courses. You buy a machine, it's what you pay for it. Any professional fees like attorney's fees associated with the acquisition are part of the cost of the machine. Cost of installing a machine, setting up special wiring or concrete foundations. That was from a personal experience I had at CBI Nuclear. These are all part of the cost of the equipment. If you have to pay the transportation cost, if you had to buy insurance while the equipment was in transit to you, if you pay sales taxes, those are part of the cost of the asset. Here's one I believe that's on the matching for exam 2. Delinquent property taxes on land purchased. Anyone remember the letters A through J? What letter would apply for that? Because that's on exam 2. Delinquent property taxes on land purchased. You buy a piece of land, it's got a tax lien on it, you want to get clear title, and you want to make sure you get to acquire the property. So you pay off the taxes so you get clear title. How should the payment of those taxes be treated? They're not your normal real estate taxes, they're delinquent taxes from a prior event. Give me the letter. Tracy's got the list out. I think she'll have a letter for us.
Well, it's not, I'm sure it can't be excluded from anything, right?
No? Now, if we talked about regular real estate, let's say I own this building and I get a real estate tax bill from DuPage County and I pay it, that would be a business expense. But we're talking about delinquent property taxes that were somebody else's obligation that are now being paid by the buyer. Remember, didn't we just say that those are part of the amount realized? So aren't those part of the cost of the land? So it'd be letter I. They must be capitalized, but remember, land is not amortized.
I thought
or
you said it was
depreciable.
A through F. I had to pick A through F.
Oh, no, that's for, that's when we were talking about
Oh, okay.
the reorgs. No, okay. Tracy would have had it. Not on the exam, but I'll mention it. If you buy a piece of land, it's got some scrub oak on it. Let's say it's a little bit, wet in certain places, so you bring in more soil to improve drainage. You knock down all the existing trees so you can build on the property. That would also be part of the cost of the land. Now, demolition costs less salvage on land purchased. if your intent was to demolish on acquisition. This is not on the exam, but I've actually had this happen for a person I worked with when I was in the Army Reserves. He bought an old apartment building in the city of Chicago. He claimed his intention was to use the building, but then he found out that it was in such a decrepit condition that he thought it would be easier and more lucrative to just tear it down and come up with a different alternative use of that location. Now, it would be advantageous for us as taxpayers to be able to deduct the cost of demolition less salvage. Remember the salvage. Copper piping, light fixtures, we'll steal the doors, anything that we can get out of the building that we can sell. So we basically just leave a shell. Now the IRS is going to argue your intention was to demolish it altogether, so the cost of demolition less salvage should be part of the cost of the land. I want to be able to take it as a deductible loss on my return. So what might I do to convince the IRS that my true intention was to really use the building, but then later on I had to change my mind, and here came the demolition wrecking ball. What's something you could do? There's something you could do that'd be expensive, there's something you could do that'd be real cheap.
Register a company there.
Perhaps. What else? At that address, you mean? What else? What's the expensive thing we could do? But I think it'd be $10,000 or $20,000. We'll have an architect come out and do a full study of the feasibility of bringing the building up to code. But that's costly. What's something we could all do this Saturday, real cheaply?
You could live there.
All right, well, no, that's a good answer, Amy. Amy says perhaps we could use it temporarily. Maybe we could store some equipment or something here. Say, well, look, we were using it for storage for a while. I like that idea. I thought of something else, but you need to wear sloppy clothes.
Paint it?
Paint it, yes, paint it. Well, I'll get some cheap Walmart paint and we'll come over here and we'll slap paint on the walls for the first floor. It'll probably cost us a day of our labor and a little bit of money for the paint. And we'll say to the IRS, well, geez, why would we have wasted a whole weekend painting if we intended to demolish the building? So these are the type of things some of you came up with here and that I used to face a lot when I was handling IRS audits. Now, basis of property acquired by gift. I have a handout well, let's look at the handout that we have. I have another handout with a problem from the text. And I'll give an example too. I want to spend a little bit of time on this because there's two problems on the exam. If you acquire property by gift and you use it and depreciate it, or you acquire property by gift and you sell it at a gain, your basis is the donor's carryover basis. Now, one thing we'll see again later in the term, and if we had more taxes together, we'd see it even to a greater degree. When you have somebody else's basis, the transferor's basis, you also receive all the attributes associated with that property. And one of the attributes is holding period. Let's give a quick example. Let's say that your father owned stock for which he paid $10,000. He held it for 6 years. Okay, $10,000, held it for 6 years. He gives it to you as a gift when it's worth $11,000. He paid 10, held it 6 years, gives it to you when it's worth 11. You hold it 6 months and you sell it for $11,500. What will be the nature of your gain? You sold it at a gain. What's the nature and what's the dollar amount? 11.5 is the selling price, right? What's the applicable basis? Is it the fair value of the gift or is it Dad's basis? It's Dad's basis. It's Dad's basis, so it'd be $11,500 minus Dad paid $10,000, right? So you'd have a $1,500 gain. Dad held it 6 years, you held it 6 months. It's a stock, it's a capital asset. Is it long-term or short-term?
Long.
Long-term. That's right, because since you have Dad's basis, you also have Dad's holding period. So your holding period is 6 years and 6 months. Now, we're going to look at a problem in the text in a second with another handout. Again, Dad bought stock 6 years ago for $10,000, gives it to you as a gift when it's worth $9,000. He paid $10,000, gives it to you as a gift when it's worth $9,000. You hold it 6 months, and it now is worth $8,500. So you sell it before it goes down anymore. So you sell it for $8,500. Now, what is the nature and amount of your loss? Selling price is $8,500. What's your basis? Is it Dad's? Well, let me see. Is it Dad's 6,000? Is it 95? Let me change the example. Let me try it again. I want to give something more extreme. Dad paid $10,000 for it. He bought it 6 years ago. He gives it to you when it's worth $8,000. You sell it for $7,500. Okay, he paid 10, 6 years. You owed it 6 months. It was worth $8,000 when he gave it to you as a gift. You sell it for $7,500. Selling price is $7,500. Now, in determining the loss, what do you subtract? Do you subtract the $8,000 fair market value of the date of the gift, or do you subtract out Dad's $10,000 basis? Let's look at the rule. For loss purposes, it's the lesser of the gain basis. The gain basis we said was $10,000, didn't we? Or fair market value at the date of the gift, and I think we said that was $8,000. So it's $7,500 minus $8,000 would be what, a $500 loss? Short term or long term? Well, we don't have Dad's basis, so we don't get Dad's holding period. So what is our holding period? Short term, 6 months. Our holding period started with the date of the gift. So we're going to go, and this is an informal handout. We're going to actually open our text. That'll be very exciting. And we're going to look at a problem involving Maria and Peggy, although I'm going to want to add holding period to the problem. I want to go over this in more depth because this is a significant area, and I think it's a tricky area. And maybe I'm overreacting.
Thank you.
Okay, problem 10-38. Now, if you don't have your book open or anything, that's fine. You don't really need it. You can always look this over later. I'll just read the facts to you. Okay, I should have had my book open. I didn't do that on Tuesday either, and I vowed I would do it. Okay, 10-38. It's, well, I can't give you a page number. There are no page numbers. But anyway, it's 10-38. Maria gives Peggy property worth $15,000. So fair market value at the date of the gift is $15,000. Let's assume Maria held it for 6 years. They can give holding period. I'm going to assume 6 years. Maria's basis in the property is $10,000. So she paid $10,000, held it 6 years, and it's worth $15,000. Part A. Peggy, let's say after 6 months, we're putting in 6 months. Peggy, after 6 months, sells it for $17,000. What will be her gain or loss on the sale? And what would be the nature? Well, first of all, is it going to be a gain or is it going to be a loss? She sold it for $17,000. Well, it's going to be a gain because that's larger than any of the other numbers that appear in the problem. So the gain rules per Bill's handout say it's to be the same as the donor's basis. What was the donor's basis? 10,000. Remember, that's what she paid for it. So $17,000 selling price minus the donor's basis of 10,000 would be a $7,000 gain. Holding period would be both Maria's plus Peggy's. The official language is the holding period tax on. It tax on to the property. So this would be a long-term capital gain. Everyone see that? It's similar to one of the exam problems. What do some students do that frustrates Bill? They'll say it's short term. But remember, when you have the donor's basis, you get the donor's holding period. Some people will use fair market value, and that makes Bill's heart palpitate. Because we said the gain basis is the donor's carryover basis. Now, let's look at B. B is unusual. If Peggy sells the property for $5,500, oh my God. It was worth $15,000. 6 months later, it dropped to $5,500. What's her gain or loss? This is unusual, B. Well, let's look at it. Selling price $5,500. The loss basis, well, the lesser of the fair market value the date of the gift, that was $10,000. Excuse me, that was $15,000. Or the donor's carryover basis, and that was 10. Gift was worth 15 at the date of the gift. Donor's basis was 10. 10 is less than 15. So the $10,000 basis would apply, and we'd have a $4,500, and again, it'd be long-term capital loss because we had the donor's basis. That's unusual, isn't it? That's not likely to happen on the exam. But C could happen. A and C are the most typical situations. Let's look at C. What if the fair market value on the date of the gift was $7,500? So Maria's basis was 10. She bought it 6 years ago. It's worth $7,500 on the date of the gift. Peggy sells it for $5,500. What's the gain or the loss? Well, it looks like there's going to be a loss here, because the selling price of $5,500 is less than any of the other figures. So take the selling price of $5,500. Now let's determine what the loss basis is. It's the lesser of fair market value the date of the gift. That was $7,500. Or donor's carryover basis, and that was $10,000. Which is less, $7,500 or $10,000? $7,500. So we have a $2,000 loss. We don't have donor's basis. So when did our holding period start? With the date of the gift. Short-term capital loss. So yes, go ahead, Lena.
Does the donor or the gift giver get to take any loss on that?
Donor has no implications here. The only thing the donor would have would be if they had to pay a gift tax. I have that down here in the handout, and that's not a income tax, that's an excise tax. What, by the way, this is off the subject, but we're talking about gifts. What is the amount that you can give to a donee per year without any taxable excise tax against you? 14,000. 14,000, that's right.
So that 2,000 just sort of vanishes?
Well, no, it goes on the tax return basically of Peggy.
Okay.
Because Peggy's the one who had the sale transaction. But you're saying, well, Bill, gee, Maria held the stock all this time when it went down, and no, Maria gets no tax benefit there. Exactly. Situation D, I've never had happen in real life. I'll leave it for you. I guess it could happen based on the numbers. Believe it or not, that situation D was actually on the exam for Accounting 429, an inordinately hard exam at the undergraduate level, where they're not as well equipped as you guys are. Anything else on gifts? I think, Bill, when I study gifts, I should have a nice, strong beverage. Now, the last two of the multiple choices are going to involve receiving property acquired by inheritance. On the exam, you're going to acquire investment land, from your dad when he passed away. Look at your basis. Fair market value at the date of the decedent's death, or the alternate valuation date. And does anyone know what the alternate valuation date is?
Like 6 months after that.
That's right. Tracy's right. 6 months after the date of death of the decedent, because you can elect to have the estate evaluated at that date. That won't be an issue for us, but just in passing. So let's say your grandfather bought IBM stock in the early 1950s at basically at the equivalent of $1 a share. He's a lot older now. He wants to give it to you as a gift, where it would be the equivalent of worth like $10,000 a share if you adjusted for splits and stock dividends. He paid $1 a share. It's worth $10,000. He wants to give it to you as a gift. What you might do: Granddad, I appreciate your beneficence, but you are older and in the twilight of your life. I think it would be better for tax purposes if, instead of giving it to me as a gift, because then I'll get your basis of $1 a share, you leave it to me in the will. Because then if it's worth $10,000 when you die, that will be my basis in the property. So all that appreciation and value will never be taxed. That's one of the arguments to keep the estate tax. Because at least with the estate tax, some of that appreciation and value will go into the taxable estate. Eliminate the estate tax, though, and all that appreciation and value will be forever lost. It's interesting to note that rule was changed in the 1978 Tax Reform Act. But it was a provision of that act that said it would not take effect until 1 year from the date of enactment. Before that year elapsed, and before it became the law, they withdrew the rule. So we've never had anything but a step up in basis for inherited property. It was interesting to note that the liberal Kennedy family were against that rule because they had a lot of money and they wanted to go to, to their particular beneficiaries at the fair market value, not their original cost. Now, let's say that Dad left you some investment land. He held it for many years. You hold it for 2 months, and you sell it at a gain. The law says that if you inherit a capital asset and sell it at a gain, and you held it for less than 1 year, the nature of your gain will be long-term. It says if you inherit a capital asset and hold it for more than 1 year, this section does not apply. Why don't they put it in English? The gist is, it's always long-term. But then as accountants and attorneys, we wouldn't have jobs. So, I mean, this helps job security. So on the exam, there's 2 exam questions. The last 2 are the multiple choice. Son's going to inherit investment land from Dad. Key factor here, when he inherits it, he's going to sell it. In the first property, he's going to sell it at a gain. Second property, he's going to sell it at a loss. I mean, it's a capital asset. You could have a loss. It's an investment property. So what will be your basis? Don't confuse this with the gift rules. What will be your basis in the investment land you inherited? Fair market value. Please. Please. That's right. Fair market value on the date of the gift. Excuse me, God. Fair market value the date he died, or the alternate valuation date. I started getting myself screwed up there. Take that word gift out of the record. Fair market value. Can you recognize the loss also? Yes. Because some students, there's one answer that says neither a gain nor a loss. Some students mark that no. You can take a loss, it's an investment property, it's a capital asset. You can recognize a loss on a capital asset. Everyone set for that now? No confusion? Okay. The last item on here is one that through 2008, I said really there's not an issue here. Basis of property converted to income producing use. Somebody has posted on this. You own a condo, your fiance owns a townhouse. You're going to get married. You're going to move into the townhouse and take the condo and treat it as rental property and depreciate it. And then maybe sell it. Basis of property converted to income producing use. For gain purposes, it would be your original cost plus any improvement. For depreciation purposes, or for losses. Now think about this, if we were in 2007 or 8. The lesser of cost or fair market value the date you converted it from personal to income producing. Through 2008, which would have been less? Cost or fair market value? Cost. Remember how everyone's property was appreciating in value? So I used to say, don't worry about it. You know, it's got to be worth more than you originally paid for it. Now that's not true, is it? That's why we had the underwater mortgages, because properties have declined in value. So now that could be an issue that you'd have to consider. Okay. Now, the tax deferral sections. Originally, there were 3 tax deferral provisions. 2 of them we've been researching, and we have some handouts on them. The other one was Code Section 1034. Some of you, we've had some posts on this, but I know we had somebody, Noel, posted this in the Tuesday class. I don't remember if anyone did here or not. Probably someone did. I read all your posts at the same time. I do computer screen one in your class and their class because of the same topics. So sometimes I can forget who said what. Now, through the end of 1997, if you sold your personal residence at a gain and you reinvested in another residence of equal or greater value, you could defer the gain and make an adjustment to the basis of the new property. That, of course, was repealed in the 97 Act. The other thing that was repealed in 1997 was something that was enacted in the 70s. It said that for those who are 55 years old or older, they had a once-in-a-lifetime $125,000 exclusion if they sold their personal residence. That was an intricate area, because what if you sold your residence, you were 56 years old, sold it for a $75,000 gain? You'd only use $75,000 of $125,000, and there was no carryover. Or should you wait, thinking that you might sell another property later that was your personal residence, that would have a larger gain? Or you had to be careful who you married. The old folks had to be cautious, because if they married somebody who had already used the $125,000 exclusion with their prior relationship, that you could not use it. If you had the marital status, if you were still single, you could. So, but that's gone now. And they were replaced with, as we know, the $250,000 exclusion and the $500,000 exclusion, whether you're single or married filing joint. But the other 2 sections still exist. And the first one is Section 1031. Now, this was very confusing in the text, and the solutions to Chapter 11 problems are like yay thick. I'm hoping that this handout will be sufficient. I prepared this myself. Again, I'm real proud of this. Well, the sun has been right. I confess I killed Lincoln. It has been shining through at me, and I thought, well, geez, it will soon move out of the way, but it's still there. There's one benefit to cloudy days. Make sure, since the nation only give you one, see, 2 slipped out already. First of all, there's an area that I am not testing, but if you have this in real life, and you could, that would be relevant, and that is the time period in which you have to recognize replacement property. I'm not testing that, but certainly that could be an issue if you wanted to engage in a 1031 exchange. We're going to assume that the property involved in our problems on the exam are going to qualify as like kind. But again, if you have this in real life, the rules for like kind are more stringent than the rules for similar or related in use, which we'll see a little bit later on the involuntary conversion. Some of this you've had in intermediate. Let's look at the easy page 1. I have an old truck, cost was $20,000, tax depreciation was $15,000, adjusted basis $5,000. I'm going to trade it in on a new truck. The negotiated or cash price of the new truck is $25,000. Situation Roman numeral 1. Trade-in allowance $6,000. They're giving me $6,000 for my old truck. My adjusted basis for tax was $5,000. I have a gain realized. That's the economic gain of $1,000. But the gain recognized, remember, for book and tax purposes is $0. This is a deferral. You don't have to pick up the gain in the year of the transaction. Instead, the gain is going to be used to reduce. The gain will be used to reduce the basis of the new truck. If the new truck has a lower basis, what will be true of depreciation on the new truck? If it has a lower basis, depreciation will be lower. And net income will be higher for tax purposes, but notice that will be true over the next 5 years. So it's spreading the gain over the depreciable life of the new truck. Let's take a look. Cost basis of the new truck was the negotiated price of $25,000 minus the gain realized but not recognized of $1,000. So we have no taxable gain this year, and it turns out that the cost basis of the new truck is $24,000. Bill, I didn't like that way. It's too technical. Right? Layperson's way to get the new basis. Bill, I see you got a new truck. Yes, I do. Next question they're going to ask, what'd you pay for it? Well, I had to come up with cash of $19,000. The negotiated price of $25,000 minus the trade allowance. Plus I signed over title to my old truck that had an adjusted basis of $5,000. So I'm picking up the new truck at $24,000. So notice here, now there'll be a problem on the exam where it's going to be like this. You're going to this is from the test bank, so the numbers are really weird. You're going to get a new car by trading in an old car, and you're going to pay cash. And there could be a gain on the trade-in, but you don't recognize the gain. Instead, you make an adjustment to the basis of the new car. Situation 2, I'm not so happy. They gave me a trade-in allowance of $4,000. Adjusted basis was $5,000, so I have a loss realized of $1,000. I'd love to recognize the loss, and for book purposes, I probably would recognize the loss. But 1031 says I'm not allowed to recognize the loss. So again, it's a deferral. We're going to take the loss that I'm not allowed to recognize right away, and we're going to add it to the basis of the new truck. So the new truck is going to have a higher basis, which means more depreciation over the life of the new truck, which means lower taxable income. Take the cash price of the new truck, that's the negotiated price, $25,000, add back the loss realized not recognized of 1,000, and we're picking up the new truck at 26. Or how much did you pay for your truck bill? Well, 25,000 price negotiated minus the trade-in of 21,000 cash outlay plus adjusted basis of my old truck of 5 would be 26,000. Any question about situation 1 where it's strictly like-kind property and I might be paying cash, trading in an asset for another similar asset, and I pay cash? But let's flip. Now we're more sophisticated. Look at the new language. Old truck relinquished. Sophisticated language here to impress people, or not. Fair market value of the truck I'm going to be trading is $75,000. My adjusted basis of 50. This is an arm's length transaction, so what I receive is going to be recognized at fair market value. I'm going to receive Roman numeral 3. I'm going to receive in return a truck worth $40,000 and a piece of land worth $35,000. Notice that equals 75. The land is called boot. Boot. We're going to see boot in week 7 under 351. Boot here means non-like-kind property. Non-like-kind property. For example, let's say I was going to receive in return a $40,000 truck and $35,000 worth of cash. If I were receiving the cash, that's boot. Adjusted basis of what I gave up is the old truck, $50,000. I have a gain realized of $25,000. Look at the bold print. Gain is recognized to the extent of boot. What's the boot here again? $35,000. Ah! But the gain recognized can never exceed the gain realized. So although the potential gain here was $35,000, the total gain recognized can't exceed $25,000. So I got $25,000 worth of taxable gain here. Put a note in the upper right-hand corner. The basis of boot is fair market value. The basis of boot is fair market value. So the basis of the land is $35,000. Please, on the exam, when I ask, if I ask for the basis of the new like-kind property, follow this format. Start with the adjusted basis of the old. The old truck here was 50. Look what we're doing next. What's next? Plus gain recognized. This is another common thread in the tax laws. It's kind of like there's a silver lining to every cloud. When you have a taxable gain, you often get a step up in basis. So plus the gain of $25,000, that's the taxable gain this year, minus the boot received. So we're going to pick up the new truck for tax purposes at $40,000. Now, one of the problems on our exam next week, I'm going to be trading in a tractor. Now, I'm not a farming guy, so let's say it's a construction tractor, not farming type. I'm going to trade in a tractor for a smaller tractor, and I am going to receive cash. Since I'm receiving cash, that constitutes what B word? Boot! And it'll be like this situation. Gain is recognized instead of boot, but gain recognized can never exceed gain realized. So in the tractor problem is like Roman numeral 3. Roman numeral 4, very common. Same $75,000 truck I'm giving up, and it's just a basis of 50. I'm receiving in return $75,000. A truck worth $60,000 and a piece of land, that would be the boot, of 15. I'm giving up the old truck with a basis of 50. Gain realized, 25,000. Gain is recognized to the extent of boot. What was the boot here? 15.
15.
So taxable gain, 15. Basis of the boot is fair market value, 15. Basis of the truck, take the adjusted basis of the old truck of 50, add back the taxable gain of 15, subtract out the boot received of 15. Notice those are often the same. And the new truck is picked up at 50,000. Questions on this handout? Well, if any questions arise before next week, you know how to reach me by email or by phone. Now let's talk about the